Welcome to the Morrows Private Wealth Market Update for the 8th of April 2020. My name's Chris Molloy. I'm the Chief Investment Officer for Morrows Private Wealth, and today we'll provide an update on where markets are at, given a lot has happened since we provided our last update several weeks ago. During March, we saw volatility reach significantly elevated levels that we hadn't seen since the GFC back in 2008. Just on the right chart here, we can see that volatility index has fallen from its peak levels around the 85 mark and now trading back down towards the 45 mark. So volatility has declined, but it is still elevated relative to history because we've got to go back and look at other crises to look at volatility that's still at the same levels. We've had the quickest sell-off in Australian history with the ASX 200 falling 30% really quickly, even quicker than the 87 crash. We've also seen the quickest sell-off in US history. So stocks posting their fastest 30% drop ever. It only took 22 trading days. And we've got to go back to the 1930 depression to see other periods where markets fell 30% so quickly. What surprised us during this recent sell-off is that typical safe haven assets weren't safe during this initial sell-off. So we can see here that gold initially fell more than 10% during the March sell-off, has since recovered to be that safe haven asset, but it didn't protect investors initially. Government bonds also sold off. So after yields fell down to 60 basis points for 10-year government bonds in Australia, they rose up to more than 1.5%, which is a capital loss for anyone holding those bonds. Since that time, bond yields have fallen again, but during the peak of the sell-off and crisis, bonds didn't protect capital for investors. Credit markets also experienced significant losses in the vicinity of 20 to 30%, as we can see by this red circle, with spreads really selling off to around 11%. But since mid-March, we've seen those spreads start to narrow and credit markets have recovered, and there's less panic now within credit markets. Oil experienced its worst month ever, falling about 44% during March, and we can see that sharp decline in the chart just here. Falling oil prices have also put significant pressure on high-yield credit markets, particularly within the energy sector within the US. And we can see that credit spreads for energy high-yield companies really spread out to almost 23%. And have started to fall back as markets have become more comfortable. But with oil prices trading so low, that whole energy sector, high-yield energy sector in the US is still under a lot of pressure. So we've just seen the worst quarter for oil, down 66% in the March quarter. But just to highlight the type of volatility that we're still seeing in markets, only last week we saw oil have its best day ever, rising almost 25% on the back of the Saudis, Russia and the US talking about potential production cuts. So significant volatility still in markets. Share markets have also rallied off their lows of mid-March. The Aussie share market fell 37% peak to trough. The US was down 34%. And those declines have now narrowed closer to that 20 to 25% down range. Energy sectors were the worst performing and financials as well. But most sectors have started to recover. But when we look at the US market, the Dow from peak to trough was on track for its worst month since 1931, staged a recovery later in the month, but ended up finishing for its worst quarter since 1987. We saw defensive assets significantly outperform growth assets during that sell-off from the 19th of Feb to the 23rd of March. So consumer staples, utilities, healthcare fell significantly less than energy, real estate, consumer discretionary, and the like. During the recent rally, though, that has completely reversed. Energy's been the best performing sector, IT, consumer discretionary, real estate, whereas those more defensive sectors haven't rallied as far, but they also didn't fall anywhere near as far. Despite the falls in the market still down around 20 to 25%, the markets aren't cheap. What we're seeing on the left-hand side here is the US market PE valuation, and on the right, the Aussie market PE on a forward-looking basis. And we're back to the long-term averages for market valuations. So even when markets were down 37% here in Australia, they still didn't get anywhere near as cheap as what they did during the Euro crisis in 2012, and definitely not as cheap as 8 times during the GFC. So despite the falls, markets still aren't cheap on a long-term historical basis. We're going to see significant earnings declines ahead. Similar magnitudes to what we saw during the GFC is what's expected. The US reporting season kicks off next week, so we'll start to get a feel for the magnitude of earnings declines that a lot of the corporates will start to post as of next week. And at this stage, we're not expecting a lot in terms of guidance, forward-looking guidance, just because it's hard to give forward-looking guidance when half of the world is in lockdown. Looking at Australia, we can see that of our big 4 banks, CBA is still trading at a premium to the other 3 banks, ANZ, NAB and Westpac. And on average, their valuations are back below those 08, 09 GFC type levels. So they're looking cheap relative to history, but acknowledging that we do still expect to see dividend cuts, they'll probably have to raise capital. There's still some risks around the banks, even though they are looking quite attractive relative to historical valuations. So the question we're asking is, are markets likely to consolidate lower from here? The chart on the left here is showing that peak to trough decline of 37%, and then markets have recovered around 20% off those lows. But when we look at other prior bear markets and recessionary environments, we can see here that the market has sold off quicker than any other period. But what typically happens is the markets then find a consolidation phase before ultimately bottoming out, as they did during the 87 crash and also the GFC in 08, 09. So we don't think that a 1 to 2 month crisis is likely to have seen the bottom of this for markets. So our expectation is that markets will start to consolidate lower and retest those lows seen in mid-March. We've definitely got a recession. We're in a recession now, and we're seeing that with some of the economic data that's coming out. The question that are on people's minds is, what's the magnitude of that recession? What's the duration? How long are we expecting to be in a recession for? Now, we've seen massive amounts of monetary and fiscal stimulus be provided by central banks and governments around the world. Unprecedented, much more significant than what we saw during the GFC in a much quicker time frame, and there is more to come. So the stimulus is really what's caused this current rally, relief rally on the back of that stimulus, and now we've got to see whether it's sustainable. When we look at China, which is where the coronavirus eventuated and started, their economy shut down hard for 12 months, and we saw manufacturing and services absolutely collapse there. But within a month, it's rebounded back to above where it was prior to the crisis. Whether that data is accurate or not remains to be seen, but China looks like it is already on the other side of recovery. The problem we've got is that the coronavirus is now a global pandemic, and it's about to hit, or it is hitting, the rest of the world. So what this is Goldman Sachs forecasting GDP in the US, so negative 9% Q1 and a negative 34% Q2 GDP decline. there's nothing in history that even compares to those kind of declines. So it's really now a matter of, is this a short and sharp type of recession lasting for 2 quarters, or does it extend into Q3 or Q4? Markets are currently pricing just a Q1, Q2 recession, and then a recovery starts to eventuate into Q3 and Q4. Unemployment will be the real key here as to how deep and prolonged this recession could be. So in the last 2 weeks, what we've seen in the US is more than 10 million people apply for unemployment claims. Whereas when we look at the first months of other prior period recessions, the maximum was 2 million people claiming within that first month. Well, the magnitude of this current recession shows that 10 million people applied in the last 2 weeks, and that is likely to double and even triple in the coming weeks and months. So unemployment is going to spike significantly higher. So to change that, people need to get back to work. And at this stage, we've got around 50% of the population currently in lockdown, unable to actually go out and be productive in their workplace. Now, plenty of people can work from home, but the magnitude of those job losses is really the result of lockdowns for businesses not being able to trade or open their doors. And the chart on the right here shows the Las Vegas Strip is just empty. And that's the reality. And really, it's a matter of how quickly people can get back to work and the authorities can enable people movement again will determine whether this is a U-shaped recovery or turns into something more prolonged and more likely to be an L-shaped recovery that has longer lasting effects. So we haven't seen coronavirus case counts peaking yet. In Australia, we've had some good news that may have turned around by the middle chart there, but globally, we're still seeing case counts rise exponentially. China's tapered off. The US is still an issue, but it was only a couple of days ago that we started to see a turning point in the US case counts. So maybe a short-term chance for optimism that things may be turning around in the US, but it's just too early to make that call right now. So where to from here, just to recap. We're only 1 to 2 months into this crisis, and we don't envisage a V-shaped economic or market recovery. All investment markets reacted savagely to the uncertainty surrounding the coronavirus in March, but central banks and governments came out with massive stimulus policies, and there will be more to come. And that's really then led to a stimulus relief rally, but we remain skeptical that it's sustainable. We're about to see global economic data and corporate earnings collapse through Q1 and Q2 data points. And I think the market broadly expects it, but when we actually see it transpire, then that may just see the next leg down for markets. So we're in a sharp global recession. We've got no visibility about how long it lasts until people can start getting back to work and the lockdowns are removed. In our view, things get worse before they get better, and we're likely to retest the market lows that we saw last month. But out of this crisis will come opportunity, and we've got to be prepared to take advantage of these opportunities, because we could potentially see the most compelling valuations in more than a decade. And investors need to be ready to react to those opportunities. That brings us to our discussion around portfolio strategy and the opportunities that we are looking to take advantage of in the coming weeks and months. Ultimately, for where we sit now, we believe that cash is king. So we've increased cash and we're just waiting for opportunities to buy into cheap assets. Currency, we think that the Aussie dollar's got one more leg down, but from that point, we think that the Aussie dollar will start to rise over time from that point. Government bonds, we're underweight. We see very little in the way of capital protection or yield for government bonds. Corporate credit, we're underweight. Spreads have risen, but a better buying opportunity will lie ahead. Listed property and infrastructure, we don't see property as compelling, but we would selectively allocate to infrastructure going forward. Property is a really interesting one right now, particularly commercial listed property, with a lot of office buildings currently empty. We're thinking about what does that mean when eventual lockdown does change and people are able to go back to work. But businesses are going to have experienced long periods where they haven't needed to go into work to run efficiently or operate their businesses. So there's a real question over whether there is such a need for commercial real estate for businesses to actually run their operations going forward. So that's just something to watch. Aussie and international shares, from an absolute return perspective, we've got a neutral weighting. Long, short and market neutral strategies can still provide strong risk-adjusted returns going forward. So we've still got exposure there. Australian shares, long only, exposed fully to the market ups and downs. We're underweight. Earnings growth is poor and the market's not cheap yet. But for Australian shares, the low Aussie dollar will be a tailwind, particularly for offshore investors to allocate capital to our markets. International shares, long only, we're underweight as well. Again, global markets aren't cheap, but opportunities will arise on a hedged basis going forward. Liquid alternatives, we're underweight, but strategies with diversification benefits are highly regarded, but we need to be very selective here. And we're actively looking in this space. Illiquid alternative assets have moved from overweight to neutral. Private markets and illiquid strategies still provide a long-term return premium, but with where the listed markets are currently valued and where we think they will revalue lower, then having to lock up capital for 5 or 7 years is not as attractive as buying markets that may be down 40 or 50%. So we're more neutral on the illiquid alternative assets from here. So I'll briefly discuss each of those in a little bit more detail as to how we're applying them to our portfolios. So the majority of our portfolios are currently unhedged. So we've got US dollar exposure. And at a 60-cent exchange rate with the US today, we think it could fall back and retest the recent lows, which was 55 cents. And at that point, we would be looking to hedge our foreign currency exposures in anticipation that the Aussie dollar will rise over time. At some point, the US Fed will not want as strong a US dollar as they've got now. And both the US government and Fed will implement strategies to start to put some downside pressure on the US dollar, and that will mean that the Aussie rises. So we've had good gains from a falling Australian dollar, and we want to make sure we don't give all those back when the Aussie dollar starts to rise. So we think the opportunity to buy into hedged global assets will present in the coming weeks and months. We don't see any value in government bonds with yields currently under 1%. Effectively, what we're saying here is we're going to lend to the government for a 10-year period and pick up a yield or a coupon for less than 1% per annum. So it just doesn't seem to be a very attractive reward to risk basis for government bonds. Corporate bonds, we've seen spreads start to widen. So we're actively looking at credit type of securities, but we're not looking at just broad-based investment grade securities. We want to be a lot more selective in the types of strategies that we're looking at. So that will be more in senior secured bank loans and high yield debt. And that's a space that we have been invested in before and have a lot of experience and a good understanding of that market. So what we've seen is During the GFC, the bank loan market spreads really widened as panic just set in and people didn't think they were going to get repaid and that banks would fall over. Defaults happen after the peak in spreads. And what we've seen more recently is the spreads blew out about 11% into mid-March. Now, we haven't seen defaults come through yet. We know that will come, particularly given that half the world is in lockdown and there's a lot of businesses that aren't open, and at some point their cash flow will run out despite the stimulus support from governments and central banks. But we believe spreads can widen out a little bit further, and then we would be looking to invest into senior secured bank loans. And what we see here is that from a high yield bond performance perspective, whenever spreads have widened by 900 basis points, and that's about where they're trading at today, within 1 year, we see really strong double-digit returns from those types of securities. And even over a 3 to 5 year basis, we're still looking at solid double-digit type of returns. So that's what we're looking to bring into our portfolios in the coming weeks and months, and they will be allocated to the defensive part of our portfolios because we think we're buying them cheap enough on a long-term historical basis. Equity long short strategies we're retaining. We've had mixed results from our existing equity long shorts. And part of the challenge with the current environment is just the magnitude of how quickly these markets sold off. It was panic selling, and it wasn't a case of investors or markets holding on to good quality businesses or shares. Everything just got sold. And that's typically what happens during that panic selling. And in that environment, it's really hard for long short managers to actually add a lot of value. And we saw some managers provide strong returns, but if they were overweight to oil and energy stocks, they got clobbered because that sector fell 60% when the market at its peak trough was only down 37. So it really depended on what type of exposures these funds were holding as to whether they outperformed the markets or not. Market neutral has done a fairly good job, but again, mixed results there. So we're still holding exposures within equity long short and market neutral strategies to add value for the next final leg down in our view, and also to start outperforming by being in the right stocks when this market recovery sets in. So Australian and international shares have fallen peak to trough 34 to 37%. We think that in that 40 to 50% vicinity, then they start to look really attractive relative to prior major downturns in the US, where the tech bust was a 50% decline and the GFC was a 57% decline. We think that for this current crisis and shutdown of markets, during those two prior bear markets, the economy slowed, it didn't stop. And for now, a lot of the global economy is shut down. And we think that's going to have a strong impact on economic data, unemployment, GDP growth, and corporate earnings. And that's just not priced into the markets yet. In our view, the markets are pricing in a 20% earnings decline and only a Q1, Q2 recession. But if earnings were to fall in the vicinity of 40% and the lockdown and lack of people movement extends into Q3 of this year, then we're expecting more like those 2000 and 2008 type sell-offs for markets. And that's where we will start to selectively allocate to both Australian and international shares. International shares on a hedged basis, and Aussie shares, probably small caps are going to look quite attractive. Emerging markets will look attractive. US tech. So we'll be looking to allocate to those sectors that have probably been oversold the most. Alternative assets that, from a liquid and illiquid perspective, look interesting, but we've got to be very selective. And what we refer to as there is we've seen oil trade as low as $20 and it's since rebounded, but likely to still be exposed to further downside because there's a massive oversupply issue and there's a huge demand issue. So support for oil doesn't appear like it's around the corner. But at $20 a barrel, do we see oil being at $20 in 12 months, 18 months? No. So we think there's a really good opportunity to access oil as a strategy to buy it for that longer term market reflation and recovery, whereby we would expect oil prices to recover back towards $40 to $60 a barrel. So that's an opportunity that we're watching. Gold looks interesting, but it's a bit more challenging in terms of understanding the exact direction of gold. During the 2008 sell-off, gold got hit quite hard, and it only started to rally after the crisis had really unfolded. So gold we're monitoring as a safe haven asset. And if we saw it start to fall away, then we would have a closer look at gold within that alternative asset space. So they're the types of things we're looking at from a liquid exposure, because we can buy and sell them, or buy in or sell out on a daily basis. Not that we're looking to trade them, but we've got liquidity there if we need it. From an illiquid strategy perspective, we're looking at several opportunities on a very selective basis in the renewable energy space. Selective private debt. We think private debt looks really attractive, particularly stressed credit markets will look particularly attractive heading into June and July of this year. So we're actively looking at strategies there. Private equity, we haven't seen a lot of private equity strategies marked down yet, but we're likely to see that in the next few months. And what I mean by that is, during the GFC, a lot of private businesses, well-run businesses, they saw marginal hits to their cash flow and their earnings, but they didn't see the type of declines that listed businesses saw. Whereas so private equity didn't fall by anywhere near as much in the 2008 GFC compared to the listed markets. This time is a little different because you could be a great private equity business, but your doors are closed. So if you've got zero revenues, then it's hard to value that business based on its historical earnings. So we're expecting a lot of private market assets to start to be written down in value in the coming months. And we've already seen a lot of the big industry super funds start to do that with their private equity, private infrastructure, private real estate assets. So there'll be more of that to come. But selectively, we're comfortable to look at those strategies. Pre-IPO equity has dried up at the moment. It's very difficult to list businesses when the markets are in panic and sell mode. You can't get the valuations you would like, and it's very hard to get them away. So those type of strategies, venture capital strategies, will return. And again, we'll selectively look at those. But for where we are right now in markets, that feels more like a Q3, Q4, or later in 2020 scenario when we would be looking at those types of investments. So that's a broad overview of the types of investments that we're looking to add. We have raised cash to opportunistically start to buy cheap assets. We're just not pulling the trigger just yet, but that opportunity may only be weeks away, if not months away, for us to start to buy into those assets. Now, what we're likely to see by doing this is we're not going to pick bottoms. We're not trying to pick a bottom, but we will be buying cheap assets that represent good long-term value, not on a 3 to 6 month basis, but on a 3 to 5 year basis, which means that as we start to buy into these assets, if they keep falling, then bottom line portfolio returns could look quite ugly. But we've got to remember we're doing this on a 3 to 5 year investment basis where we're likely to see good, solid double-digit returns at a portfolio level for those periods by buying into these assets when they've been marked down so aggressively. But there is a bottoming process. We're not going to be able to buy the bottom, but we want to selectively buy it on the way down and as it's rising off those lows as well. So that's what we'll be looking to do in the coming weeks and months, and we'll be talking through that with you. And given that we are in very uncertain times, we'll continue to provide these updates on a fortnightly basis. And please don't hesitate to contact your advisor if you'd like to discuss the portfolio in more detail and the types of strategies that we are reviewing. So I'm more than happy to be engaged in having those conversations with our clients as needed. But as I said, we will provide these regular updates just to give you clarity over what's happening with markets and what we're looking to do from a strategy perspective. So we appreciate you taking the time to listen to this update. Stay safe and have a very happy Easter. Thanks.